Most people think financial history is written in daylight, announced at press conferences and debated on cable news, but the biggest shifts usually happen quietly late at night when no one is watching. While headlines were focused on elections, interest rates, and market noise, China executed a move so large it reshaped global money flows, a move approaching $4 trillion in scale, and by the time most Americans noticed, the ground beneath the financial system had already shifted. To understand what that $4 trillion move really means, you first have to forget the idea that money only moves when someone wires cash from one country to another. In the modern financial world, power shifts through trade settlement, reserves, lending, commodities, infrastructure, and the quiet reallocation of capital. Over roughly the last decade, and accelerating after 2018, China has been redirecting how value moves through the global system. Start with trade. China is the world's largest trading nation, moving more than $6 trillion in goods annually, and increasingly those trades are no longer settled in US dollars. Even a small change in settlement currency, say 10 or 20% of total trade, represents hundreds of billions of dollars a year that no longer need dollars to clear. Over several years, that adds up to trillions in reduced dollar demand, not because anyone announced the end of the dollar, but because businesses quietly chose what was cheaper, faster, and politically safer for them. Then look at reserves. China officially holds a little over $3 trillion in foreign exchange reserves, but what matters is not the headline number, it is the composition. Over time, China has steadily reduced exposure to U.S. Treasuries, down from a peak above $1.3 trillion to closer to $800 billion. That difference did not disappear. It was redirected into other assets, other currencies, strategic commodities, and domestic investment channels. When a country with China's scale reallocates even a fraction of its reserves, the ripple effects can reach hundreds of billions. Do that gradually, year after year, and you approach numbers that sound unreal until you add them up. Gold is another piece people underestimate because they focus only on official figures. China officially reports just over 2,200 tons of gold, but global bullion markets, import data from Hong Kong and Switzerland, and domestic production figures suggest accumulation well beyond what is reported. Gold is not just a shiny metal. It is a neutral reserve asset with no counterparty risk. When a central bank accumulates gold, it is opting out of someone else's promise. At current prices, even a few hundred additional tons represent tens of billions of dollars quietly moved out of the dollar-based system. Over many years, that becomes a strategic pillar, not a trade. Now zoom out to lending and infrastructure. Through policy banks and state-backed institutions, China has financed ports, railways, power plants, and digital networks across Asia, Africa, the Middle East, and Latin America. Estimates of cumulative overseas lending under these initiatives range from $1 to $1.5 trillion. Much of this financing is denominated in yuan or structured to encourage yuan use over time. That matters because lending creates long-term financial gravity. Borrowers build reserves, payment systems, and trade links around the currency they owe. Slowly, quietly, a parallel financial ecosystem takes shape, not replacing the old one overnight, but existing alongside it and siphoning influence away. At the same time, China has been building depth in its own financial markets. Its bond market is now the second largest in the world, approaching $17 trillion in size. Foreign participation is still limited compared to Western markets, but it has grown steadily as global funds seek diversification and yield. Each incremental percentage point of global capital allocated into Chinese bonds represents tens of billions of dollars. Over several years, those flows compound, especially when investors rebalance portfolios away from over-concentrated U.S. exposure. Why does this feel like it happened while America was sleeping? Because none of these moves required a dramatic announcement. There was no single day where $4 trillion moved at once. Instead, it was 1,000 quiet decisions made by central bankers, trade partners, corporations, and fund managers responding to sanctions risk, currency volatility, and shifting geopolitics. From China's perspective, this was not about confrontation, it was about insulation. After watching reserves frozen, payment systems weaponized, and trade disrupted elsewhere, the lesson was clear. Dependence is vulnerability. Think of the global financial system like a CI. Thank you built around one massive highway. For decades, almost every major transaction flowed through that road. China did not try to blow up the highway. It started building side roads, bridges, and tunnels. At first, hardly anyone noticed. Traffic still flowed. But over time, more vehicles took the alternative routes because they were faster, cheaper, or safer. Eventually, the highway was still important, but no longer the only way to move. For American viewers, this matters because the U.S. benefits enormously from being at the center of global finance. Dollar demand helps keep borrowing costs lower, supports asset prices, and gives policymakers flexibility. When large players reduce their reliance, even gradually, the effects show up in subtle ways: higher long-term rates, more volatile currency markets, and increased competition for capital. None of this means collapse tomorrow. It means the margin of error shrinks. The $4 trillion figure is not a single ledger entry. It is the cumulative effect of reduced Treasury holdings, alternative trade settlement, overseas lending, gold accumulation, and capital redirected into domestic and regional systems. It is the slow migration of financial gravity. And gravity does not announce itself. You only notice it once objects start moving differently, and by then, reversing course is far harder than pretending nothing has changed. And this is where the story becomes far more uncomfortable, because once you recognize that financial gravity is shifting, the next question is who feels that pull the most and who is still acting as if the old center of mass has not moved. In the United States, public debate still frames global finance as if it were frozen in the early 2000s, with the dollar unchallenged, Treasury demand guaranteed, and capital always flowing home in moments of stress. But the data beneath the surface tells a more nuanced story. Foreign ownership of U.S. Treasuries as a share of total outstanding debt has been trending lower for years, not collapsing, but declining steadily. At the same time, U.S. federal debt has surged past $34 trillion, meaning the country must issue more bonds just to fund existing obligations. When supply rises and marginal demand weakens, prices adjust, and in bond markets that adjustment shows up as higher yields. Higher yields sound abstract, but they are the price of money for the entire economy. Mortgages, corporate borrowing, government financing all key off that benchmark. So when a large buyer like China gradually steps back, even without selling aggressively, the burden shifts elsewhere. Domestic buyers, pensions, banks, and the Federal Reserve itself end up absorbing more supply. This is not a crisis scenario. It is a structural change. And structural changes rarely feel dramatic in real time. They feel like persistent pressure, like walking uphill and wondering why it is harder than it used to be. China understood this dynamic because it has lived on the other side of it. For decades, it recycled trade surpluses into U.S. assets, effectively lending back the dollars it earned. That arrangement benefited both sides. The U.S. got cheap financing and strong dollar demand. China got stable returns and access to the global system. But arrangements last only as long as incentives align. Once sanctions risk increased and geopolitical trust eroded, the incentive to keep all eggs in one basket disappeared. Diversification became policy. This is why the $4 trillion move cannot be reduced to a single chart or headline. It is embedded in payment systems like CIPs, China's alternative to SWIFT, which now connects hundreds of banks across dozens of countries. It shows up in bilateral currency swap lines that allow trade partners to access yuan liquidity without touching dollars. It appears in energy contracts priced in yuan, particularly in oil and gas trades with Russia and parts of the Middle East. Each contract on its own is small relative to global markets. Together, they form a pattern. Think about oil, because oil has always been central to dollar dominance. When energy is priced in dollars, every importing country must hold dollars, creating constant baseline demand. When even a fraction of that trade shifts, the effect compounds. China is the world's largest oil importer. If it settles even 20 or 30% of those imports in yuan over time, that is hundreds of billions of dollars per year. No longer cycling through the dollar system. Again, no announcement, no shock, just a new habit. Precious metals fit into this picture as insurance rather than offense. Gold does not earn interest, it does not fund deficits, it sits there. That is precisely why central banks value it in uncertain times. When China accumulates gold, it is building a reserve that cannot be frozen, sanctioned, or diluted by policy decisions abroad. In simple terms, it is like keeping a fire extinguisher in the house. You hope you never need it, but you do not want to discover it is missing when the smoke appears. For everyday investors watching this unfold, the challenge is separating noise from signal. Markets still rally, tech stocks still soar, headlines still celebrate short-term growth, but underneath, long-term positioning is shifting. Large institutions think in decades, not quarters. When they see the world fragmenting into blocks, they adjust exposure accordingly. That is why discussions about de-dollarization are often misunderstood. It is not about replacing the dollar tomorrow. It is about reducing single-point dependence over 20 years. History offers useful parallels. The British pound did not lose reserve status overnight. It declined over decades as economic power shifted and debts accumulated. During that time, Britain remained wealthy, influential, and stable, but its financial privileges gradually eroded. The same process can occur in different forms without repeating the essay. Outcomes. The lesson is not panic, it is awareness. China's $4 trillion move also reshapes how emerging markets think. Many of them watched what happened when access to reserves or payment systems was restricted elsewhere. They saw vulnerability made visible. For these countries, engaging with China's financial ecosystem is less about ideology and more about options. Options matter. If you can settle trade in multiple currencies, borrow from multiple lenders, and store value in multiple assets, you are less exposed to any single shock. From the American perspective, the risk is complacency. Assuming demand will always appear because it always has. In finance, confidence is powerful until it is not. The dollar remains dominant because of deep markets, rule of law, and liquidity. Those strengths are real, but dominance is not binary. It can erode at the margins long before it disappears from the headlines, and margins are where prices are set. So when you hear $4 trillion, do not imagine a suitcase of cash moving across borders. Imagine instead a slow rerouting of rivers, each small diversion barely noticeable on its own, but together changing where the water ultimately flows. By the time you realize the river no longer runs past your city, building a new channel is far harder than maintaining the old one. And that realization leads directly into the final layer of this story, the layer that determines what happens next if current trends continue and